Today, we're going to look at what is meant by capital requirements. I'll fill you in on some of the key findings from the report, and we can then consider what might happen next. When we speak about capital requirements, we're referring to the fact that banks are required to hold an adequate portion of liquid capital. To determine what is adequate, the risks which a bank is or might be exposed to are considered. Different risk weighting is applied to assets based on their risk profile, and the capital requirements of a bank are set as a percentage of its risk-weighted assets. Minimum capital requirements are designed to create a safer banking system. It's a regulatory way of shifting the risk borne by depositors back to the bank's shareholders. When COVID-19 shocked us all last year, we were glad that banks had built up the resilience to be able to withstand market volatility. The challenge, though, is setting the appropriate capital requirement levels. Low capital requirements do not provide the required safety buffer. On the other hand, high capital requirements can increase costs for customers, reduce lending activity, and impact on competition. The Irish banking sector is telling us that the levels are too high at the moment. The industry report, published by the Banking and Payments Federation of Ireland, showed that the risk weighting for Irish mortgages is nearly 3 times higher than the European average. To give some context regarding Ulster Bank, we've been told that Ulster Bank's risk-weighted assets for all of its loans is currently more than double the European average. And because of that, Ulster Bank has about €2 billion of excess capital tied up in its Irish operations. The report shows that there are 2 main reasons for this. Firstly, risk weighting calculations look at historical data, and because of that, Irish banks are still being judged by what happened during the last financial crisis. Secondly, when Irish banks go through the courts to recover money, it takes much longer than in other EU countries, and they're also much more likely to get back way less than they gave. In Ireland, the average recovery rate is 11%. This is in stark contrast to the EU average of 46%. Some parts of the EU even have recovery rates of 90%. All banks in the Irish market are impacted by these issues. And if Irish banks see the Irish banking sector as unsustainable, it's going to have a detrimental effect on businesses and consumers. There's a big spotlight on this topic at the moment. As a result of some suggestions made at a recent Oireachtas Finance Committee meeting, we're likely to see some further engagement between politicians, the banking industry, the Central Bank of Ireland, and the European Central Bank on Irish capital requirement levels. It will be interesting to see if the Irish banking sector and its supervisors, regulators, and others can work together to see if there is scope within the current regulatory framework to set capital adequacy requirements at levels that are acceptable to everyone. Feel free to get in touch if you would like to discuss this topic further, or if you need any assistance with any restructuring or deleveraging activities. Thank you.